Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's February 18th. It is the last week of the second week of February. It's about 7:43. The market's going to open up in about an hour and 40 minutes or so. As you can see here, the NASDAQ 100 is up anything beyond random, and the Dow Jones is definitely up beyond random. 133 points higher than 75.80, and this is pretty big on the NASDAQ. Although, here's what I'm going to tell you. I wouldn't be too focused on these numbers right now because volatility is about 3 times the normal range. So these numbers are just all over the place, and I wouldn't make too much heads or tails on the data that's coming out because of the gyrations we're having, and I'll get into that in a minute. As far as Fed data, jobless claims was the only major issue yesterday. It came in a little bit higher. It was like a 240-something thousand. Manufacturing was okay. The big report for the week was retail sales, and that report did very, very, very well. Now, we're still having a lot of trouble between Ukraine and Russia. We don't know what's going to happen, but I do know this. It looks like the energy market, it looks like crude peaked out, or stocks within the energy sector peaked out about 5 days ago. If we break this downtrend, this is really, really important, so I want you guys to pay attention to this. If we can break these levels right here, if we can break below these levels, it's going to be pretty bullish for the market. It means that the fear of war, as being represented by the energy sector, is declining. And that level is 66.29. I want you guys to keep that number in mind. Also, that's XLE. Also, as I've been telling just about anybody who would listen to me over the past few weeks, the upside number on the consumer discretionary is 190, about 189, 190, right around here. If we can break above. So what I think is going to happen, here's what I think is going to happen. The less threat of war that comes to this market, the weaker the energy sector is going to get till we finally break this level. When we break this level, the 66-ish level, it'll be a pretty good time for us, I believe, to break above the resistance level on the consumer discretionary. So what you want to pay attention to more than anything else right now is the upper level on consumer discretionary and the lower level on energies. Those two sectors are going to give us a real good directional bias on the market. And as far as Fed data, that's really not what's driving the market. What's really driving the market is the bond market right now. And if you look at the bond market, you will see that it actually been rallying the last 2 days. And if the bond market continues to rally, that means the long bond has said enough with interest rates going higher. This is interest rates going higher. As interest rates go higher, you get weakness in consumer stocks. If bonds start going higher, that's a flight to quality. One of the reasons there's a flight to quality right now is because there's a higher risk of threat of the war between Russia and Ukraine, which is a flight to quality. But if we continue, and also the higher chances that we're going to have a war, listen to what I'm telling you right now. This is important. The higher the odds that we're going to have a war, the less likely the Fed is going to take any action. So those two things work together in our favor. So if we continue to see upside on the bond market, that's going to be a very, 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 very powerful signal that the market may be recovering. And you may see more upside, especially if there's less fear of war. So there's this toggle right now between the bond market, XLE to the downside, as I showed you, and potential upside on consumer discretionary. But not till we get above these levels. Nothing good will happen. And on the Dow, let me just kind of give you those levels on the Dow. Those levels on the Dow we're all the way down here. Ouch. It's 200-day moving average. It would be the 351-ish level. I want us to see us go in here. Till that happens, nothing good will happen with this market. Now, some encouraging news for you. The put-to-call ratio is at 104. It's still hovering at these upper levels. Anything above 1 means we're overdone to the downside. And I think we're overdone to the downside. And notice it keeps coming up here, but it doesn't really go much higher. That means the market is overextended to the downside. More proof of that is momentum levels on the NASDAQ. This is the number of stocks in the NASDAQ 100. 18 stocks in the NASDAQ 100 are trading above the 50-day moving average. How about that for a choppy market, right? That's one hell of a choppy market. There's 100 stocks and only 18 are trading above the 50-day moving average. But look at where we're at. This is weekly data. So maybe we go down a little bit more. If we do, I mean, 2 stocks from 18, maybe, possibly. Let's look at monthly. Maybe a little bit more. I mean, maybe. We're going back to 2012 here. So I don't think there's going to be any kind of a crash because we're already down at these levels. And if you look at the 200-day, I'm going to be objective here. If you look at the 200-day, which is like a real powerful indicator as well, I'll show you where we're at there. I mean, we're almost, look at that. This is 10 years. So maybe we'll go from 30th percentile, to 30 stocks to 20 stocks, but that's not a major downside. And this is 10 years of data. Let's go to 20 years of data. This is 12 years, actually. This starts, excuse me, 2006. It starts 14 or 18 years of data. I don't know. It's a lot of data. But how often do we go below these levels, you see? And we're almost there. So I'm not fearing that we're going to have a major crash or anything like that, but just maybe a little bit more gyrations taking us to the 20th percentile. But even then, that's just a little bit of a swing from the market. So the put to call ratio is telling us we're getting overdone. Momentum levels on the 200-day and on the 50-day, let's go back to the 50-day, are telling, I missed the 50-day, are telling us pretty much the same thing, that we're really close to the bottom here. I mean, look at this. This is, again, 2006, September. We're in 2022. So 18 years of data. I think they extended it. I think it was only going 14 years. They extended it. But look at that. Look at that. Maybe a little bit more, but even so, almost there. So I don't want to get too overextended to the put side because I think the market is bottoming out. Now, let's talk about news, which is mostly priced into this market. If you watch the energy sector, consumer discretionary, volatility in bonds, you will have a very good idea of where this market stands. So investors watch developments in the Ukraine after U.S. warned of a higher risk of a Russian invasion. U.S. has issued some of its starkest, most detailed warnings yet about how Russian invasion of Ukraine might unfold, and its Western allies went on high alert for any attempt by Kremlin to create a false pretext for a new war in Europe. I don't know what they're thinking. Russia is thought to have 150,000 military forces. I think Ukraine has like 15,000. I'm not kidding. Near Ukraine's border, and NATO allies have questioned Moscow's assertions that it was pulling back troops from exercises that has fueled fears of an attack. The crisis has hung over the markets for weeks, raising volatility. Oh boy, really? Russia is a major energy producer, and if it were to invade Ukraine, other governments could respond with big sanctions that would disrupt energy supplies, and it would derail Putin's credibility and possibly derail his position, which I don't think he would take a chance on. I don't think he's crazy at all. He's very calculating. The tensions over Ukraine added to jitters over the Federal Reserve's plan to raise interest rates to fight dodgily rising inflation, 40-year high. Consumers have been dealing with supply chain problems, high costs by raising prices on finished goods. Many have warned investors that inflation will sap their profit sales and overall operations. But meanwhile, earnings estimates continue to go higher. Oil is going down. We're near the $90 level. Is this a pullback or is this it? That's the major question, and this is why I've been telling you guys to pay attention on the energy sector and to see whether it's going to break down or not. And I told you we have to watch this very carefully, this level right here, the 66 level. Let me just break that down right here. There we go, the 66 level. Let's make it nice and even, 66 level. If we can break the 66 level, there's a good chance that the fear level will go down, and at the same time, we'll get some upside from consumer discretionary stocks that are way below that 190 level, which we'd like to see, and the Dow below the 50-day moving average. Very important. Now, next week, we're still focused on these levels. Markets are gyrating right now, and there's very little directional bias. My advice to you is this. When there's a threat of a tornado, what do you guys do? Do you go outside and try to find how to take advantage of it? No, you hide. You hide in the bunker, right? Well, look at this volatility. We went 34,700 to 34,200, 600 point swings every day. Now, the good thing is that most of these price swings are remaining near this area right here. So it's concentrated. In other words, I don't think this volatility will expand if the market starts trending again. But as you could see here over the last month, we literally had a lot of volatility and went nowhere, which is making directional trading, which is what we do, extremely difficult because you have all this volatility and you have no movement, right? So you get in here and it goes down. You get in here and then it goes up. And at the same time, you've got that crazy volatility, which makes options crazy expensive. So we need to slow things down, which is what we've been doing the last few weeks, and focus on preservation, right? This is not a time to be a cowboy. This is a time to preserve your equity. This is a time to be a cowboy right here. This is a time to be a cowboy right here. This is a time for preservation of equity. So we've been very, very slow to give out new trades because options are so expensive. At any major rise, any little rise or downside, it's already priced into the value of the option. So we've got to be careful and watch these levels. Usually we're very aggressive, but right now we got to be very carefully. And in light of that, folks, I've got some very exciting news for you. Because the markets are crazy volatile and we're having all this nonsense in the market right now where it's very hard for traders to trade directionally, I'm opening up the doors to my live trade room session today. And I want to see you there. Yes, I want to see you there. There's not going to be any cost today. Inside the trade room, I cover current market levels to keep your eyes on over the next 2 weeks, current volatility update and what to expect next, market sentiment and what that means for your money in real time. The markets will be open. Earnings and the best way to take advantage of them. I'll also cover my 13F filings and show you what institutions are piling into. We just got that yesterday. It's hot off the press. Your VIP trade room complimentary session begins today, 11 a.m. Eastern Time. It's happening today at 11 a.m. Eastern Time. I want you to follow the link below to check it out. Now remember, Monday, markets are closed. So Tuesday, we're going to cover the strongest sectors, strongest stocks, weakest sector, weakest stock, give you a full market update that we missed from Monday. And hopefully this Russia-Ukrainian tension will de-escalate a little bit more. Keep your eye on the energy market. It'll tell you everything you need to know. Follow the link below this video. If you're watching on YouTube, it'll have it. It'll be the first link, 11 a.m., no cost. This is my premium VIP room. This is where I take out the big guns. So don't miss out today, Friday, special session because of the craziness in the market. The markets are in a crucial position right now, and I want to make sure you guys have everything you need to take advantage of it. Follow the link below and send me some letters. support@marketgeeks.com. I want to hear from you. Bye, guys. Have a great weekend, and I'll see you at 11 o'clock in my room. Link below. Bye.